The risk dial is still firmly stuck in negative territory. This naturally means absolutely nothing for price action for the next day or the next week, but it still gives us a flavor of where we are in terms of risk spreads. Remember that this is a compilation of thousands and thousands and thousands of prices, and therefore it indicates that we are not ready to make substantial rallies as yet in risk assets. If we look at what the moving averages are doing, and I always look at that, they're very wide apart, and that to me says time needs to pass at these lower levels to let these moving averages catch up with the price, and only then will we be ready to make a turn upwards. What does that mean? That means we will explore it naturally in far more detail, but that means that we are likely to chop around in a 5 to 10% range for an extended period of time, probably the whole of Q1 in 2019. And having said that, we will go now and absolutely look at everything in much more detail and break it down in far shorter time sequences. Good morning, ladies and gentlemen. Hope you had fun last week when all our positions basically made very good money, and now we have to figure out what happens next. We'll start by reviewing the bond markets as we always do, and this is my bellwether at the moment, the 5-year note, which I think is the most important one to look at. Basically, when Powell came out and started speaking on the 19th, we were trading around the 270 area, and we have come off all week, and we are now testing the very important level around 253. I find it very difficult to believe that the market is going to break it. I think the likelihood is for more sideways action and a retest at some stage of the 267 area when Powell spoke. I just find it very hard to believe that in the next few days, with the government shutdown and the absence of data, it's almost certain that non-farm payroll data will be delayed. We then are more likely than not to range trade between the 253 area and the 267 area. We need to give time for this 200-day moving average to start rolling over. That's going to take time. It's going to take quite a bit of time in this area, and that is what I expect. I, on Friday, sold quite a few of the call spreads that I have on board, and I just don't see this continuing with any impetus. If we look at TLT, so the 20 to 30 year area, we see even here that we have these completely flat moving averages. The market has not in the 30 year made a higher high like in the 5 year. I told you a while back I prefer to be long of the shorter end and only buy duration later on when the move has been confirmed. I think now the likelihood in TLT is that at some stage we do have these retests back towards the 118 and something big figure, something like here, 119, just below 119, something like that. That is where my bids are going to be. I don't think the market has got the impetus to take out the 121, 122 area again for the next few days. I think it's much more likely that January, the first week of January, has a positive effect on equity flows, and therefore probably a slightly negative impact on bond flows. So I'm more inclined to wait for a pullback, take profits and positions, and always have a core long, but wait for retests of this area just above 118, the figure. Before we look at the technicals, I just wanted you to see just how extraordinary what happened last couple of weeks is. Look at even 2007, 2008, the early part of 2009, and look what happened in December. What definitely has happened is that the Blue Angels have started rolling over. But does that mean we just crash? I don't think so. I have several reasons not to think so, and that is that for the best part of a while I would expect the times 14 to times 15 area to trade, possibly coming down as to retest this level. But I just wanted you to see just how extraordinary an event we have witnessed. Me from afar and you from close up. It is really something that nobody could have expected had they not looked at the risk dials and had not been in a risk off position. But does that mean we just continue and continue? I think that is probably the most unlikely scenario. The most likely scenario is that we do something like we did here in 2011 and chop around for an extended period of time, probably a whole quarter. I want to show you the chart which I've now inverted from the normal look that we see, and this is basically the 10-year in Germany against the 10-year in the US. This is going to be the critical level. 245 in spread yield. I will mark it and then we will look at it each and every week, because if we start breaking this 245 level, the likelihood is that we go a lot further, probably around the 210 to 2 area. That is going to have major implications for the value of the dollar. I don't think it happens yet. I think it'll now flatten. It'll turn out to be one of these periods, but we need to keep a very positive outlook on this and really study it, because any close, I would like to see 2 closes above, below 245 in yield. If that happens, I will turn major league bearish on the US dollar. Not yet, but it's got some warnings out there that I'm beginning not to like, and what I think is that the easiest way for the Trump administration to support the equity market in the States is to weaken the dollar. Just like I thought 2 years ago that people buying dollars on Trump's election were mad and that Trump wanted a weaker dollar, which was proved correct eventually. I now think that at some stage they will make a positive effort to weaken the dollar. It's not now, it's probably not in the first quarter, but I am no longer going to take bullish signals on the dollar in very large size. I will now be looking to do the opposite at some stage. Weekly chart of the Bund. The Bund is everyone's bugbear. Everybody would like it to go up in yield. It's not for a very simple reason that there aren't any Bunds available for trade. The ECB owns them all. The ECB will not let you have them. The ECB will keep on rolling their holdings. Germany will issue very little, and therefore I see absolutely no reason for the foreseeable future to be short of Bunds. In fact, this is the key 16 basis points level. Yes, 16 basis points level, that if we start closing below, we're probably going back to -20 in terms of yield. Who would have thought it? Well, the market always makes a fool out of all of us, and this is more likely to go to -20 in my estimation than it is to go much higher in terms of yield. I would do absolutely nothing with it. The Bund at the moment is being used exclusively as a spread instrument against the Italian bond and against the US 10-year. That is all you can do with it. Completely ignore it from now on. Don't even think of taking too many positions in Bunds. Chances are, unless it's through options, chances are that you will just get squeezed. So today, before we go to the equities, in fact, while we're going to the equities, I want to show you and start with European equities. This is a chart that I've had up for a long time, and it's a weekly chart, and you can see it goes all the way back up to 2007, and you can see how well the market has respected these forks basically, and last week we got to within a couple of ticks of it. Now, what do I think is likely to happen? Well, I think this is likely to happen, this kind of behavior, or this kind of behavior. We have definitely reached on the weeklies a very oversold position in Europe. Now, Europe is by far the worst stock market because it just got nothing to look forward to, really. So unless we're going to be hugely surprised, it is unlikely that Europe takes out this trend line over the course of the next 4 or 5 weeks. These are weekly bars, remember. Just gives enough time for all these moving averages to roll over. Well, if Europe is going to go sideways for a few weeks, why on earth should the US get killed? That's what I keep on asking myself. And I really don't see a reason, but we'll explore that in detail now. Let's look at the VIX as clues to what the US market is likely to do. You can see that the VIX actually has closed the week lower and has actually closed within the Bollinger Bands. It keeps on taking out the tops of the Bollinger Bands and then coming back in. To me, it's far more likely than the VIX comes back to this kind of level. 24 in the course of the next couple of weeks allows all this pressure to build, and then at some stage goes back up to 35. So I can't really be bullish on the VIX. I think the upside is quite limited and the downside is much greater than the upside at the moment, in which case this kind of area, 24, 25, 23, 25, I would love to own some, but really not till it gets there. This to me says a range-bound market for the next couple of weeks. Let's start off with ES, SPX, whatever you like to call it, same thing, on a monthly basis and work backwards. Wow, what a level it hit, right? That's exactly the level we bought, 23.32, and then it just bounced like nobody's business. So what's it likely to do in the months ahead? Well, this is still support, this moving average is still rising, these are capping from above. So these are the levels on the upside. What's that? 26.30 going back up to 26.90. 26.30, 26.90 upside. I would say no more than 26.25. Okay, so that's your upside, and your downside is still somewhere around here, 23.70. I know that's a 300 point trading range or whatever it is. We will narrow it down naturally, but this is what I'm saying. Would it surprise anyone if we had 2-3 bars, and these are monthly bars, going sideways now before anything major happened? Shouldn't be a surprise in the slightest to anyone. Down a time frame, weekly, and we did hit it at the same time. Isn't it amazing? It's like these algos are programmed to do it all at the same time. That is why I was so confident that 2632 level, 2634, sorry, was going to be a very, very important level. And I do love the way the market always returns to the scene of the crime. This is where it broke the Bollinger Band the week before, and it's come back to the scene of the crime 25-30-ish. And funnily enough, that is also where Powell started speaking, 25-50. So we have a much more bearish look from these moving averages above, whereas the 2690 as well on the weeklies is the upside. This Bollinger Band is going to be somewhere around here in the 2420 area. If we now have a look even better, I really do not expect the 2400 level to be tested or broken next week. I think it's far more likely that we trade at some stage up towards the 25-50-60 area and then swoon back down into the 2400s. That is far more likely to me than we just go down hard and keep on testing these levels and breaking them. I'm sorry not to be as bearish as most of you out there, but I don't care. That is where I think I can make money. I can make money now by probably being slightly short of volatility, and I can probably make money by buying dips or selling deep out the money puts. And down to the daily, where we can really start to drill down on some very important levels. I have placed the retracement bar here on this point, which I think is far more important than that point. That point was already tested and worked on. Yes, where does the 0.618 retracement come to? Comes to 25.55 or whatever it is. 25.55 is a good enough level for me to want to short it, but really I don't want to buy it until we get back down to these levels, which are supportive, which is around 24.35, 24.30. So I would say next week, and really for the next couple of weeks, 24.25 to 25.55. Those are the levels that I can see trading. Now, if somebody asks me from a longer term perspective, where are we? I would probably say that we are in some sort of a fourth wave. Having had the first wave, the third wave, and now we're waiting for the fifth wave, where the fourth wave is where everybody gets chopped to death. I don't really want to trade it apart from the extremes being here around 25.55. That gives me extremely good risk reward in being long of put spreads, and really at the same time I would probably want to be short of 2400 puts for the course of the next week. If we come down to the very, very short term, these are 10-minute bars, and you can see that this was where we started collapsing when Powell spoke. This kind of area, yes, 25.50, 25.60, 25.60, let's call it. This is the area that I want to be short. This is the area where I want to sell them. And really, I think that this area of support, this band of support here, around 24.02 all the way to 24.25, is likely to hold the market unless some very bearish news comes out. So I know that some of you are going to consider a 120-point weekly range in the S&Ps as peanuts. I would say expect lower volatility. That's what I would say is the answer to your mistaken expectations. I wanted to spend a few minutes on the dollar because, as I said earlier, I think we are getting somewhere close to a change of policy. I only suspect it, I have no evidence, I have no knowledge, but it's something that my sixth sense says that they are more likely to resort to than not. I thought so here, and the market just went up after the election of Trump, and then it just rolled over and died. So I was wrong, and then I was right. Here I will probably be wrong, and then I will be right. There is no evidence here yet that, because the 200-day moving average is still sloping very nicely upwards, the market is way above it. There is no evidence for what I'm telling you. I just get a sixth sense that things are not right. Now, could the market still go up to 100, 101 and higher? Absolutely. I am not going to put on any positions. I am going to start looking for some cheap puts at some stage. And very much what I've been saying for a long time, that if the market gets down to this 93.63 level, that's going to be a very important level. From that level, it either bounces like crazy to above 102 or absolutely collapses. That is still something that I'm going to be very aware of. I'm sorry not to be able to give you more definitive guidance on the dollar. I just get the feeling that something big is going to happen at some stage next year. I get the feeling that the volatility is going to transfer itself from the equity market to the FX market. I've always been a believer that not all asset classes get volatile at the same time. That is why I have not been recommending any volatility in FX. I've been recommending it in bonds, and I've been recommending it in equities. I think that next year the surprise is going to be that the volatility is going to be transferred into FX from those asset classes. That will suit just about everyone. Maybe not the European Union, but nobody's going to ask them. So that is what I am afraid of. I see no evidence of it at the moment. I just wanted to give you a heads up, and you can then think about it and see if that is something that you would like to think about and position at some stage. I will definitely keep you informed as to my views. At the moment, my view is that it's stuck around this 96.50 area, which is so important. And at some stage, it's going to start making a move. Probably not now, but I really think volatility is going to be, as an asset class in FX, is going to be the big thing for next year. I'm often asked, Nick, what do you want to see to start getting bullish of the stock market in the States? Well, this is what I want to see. I want to see this blue line, which is now stuck at the bottom of the chart, start to improve. I am a firm believer that there is absolutely no way that XLF rallies hard unless this line changes and starts going higher. I think it's now going to consolidate, and that's going to allow XLF to go sideways and maybe do a little bit better and take the market back up to 25.50s. But that is not a rally. That is not a reason to start getting bullish of the US stock market. That's just better levels to sell, right? To me, this is the key chart, and I will be watching it. As soon as we start getting disinversion in the short end of the curve, the banks can start making some money, and XLF, which is 20% of the S&Ps, can start rallying. Until that happens, it's very hard to see anything but retracements back up towards levels that are good sells. Anything above 2050 is going to be a great sell here in XLF unless this starts changing. That is what I'm watching like a hawk. I cannot get bullish longer term of the US market unless this changes. So what are the biases for next week and the first part of January? The first part of January was, remember, has some decent positive flows to it in terms of equities. So I think I would like to see a retracement towards the 118 handle. Certainly not much lower than at 118.50 in TLT and around the 267 yield in the 5-year note. I think that would be a great level to get to reload. Bunds and Bobble, I just don't touch them. I mean, enough said. SPX, I expect a major league chop between 2560 and 2400 for next few weeks. That is my conclusion from having thought about it quite hard. And, you know, a wave 4 chop, up, down, you're stopped. Well, that to me is the most likely outcome. I still don't like NQ, although it will outperform on the upside, but it will also outperform on the downside, underperform. So be very careful with NQ. It's coming to it's at levels that I just don't see value longer term. VIX, I am not as bullish as all that as I described. I think you want to let it come down to the 23-24 area to nibble there. To me, this is too high for what I expect the market to do. European equities, as I said, I don't see anything bullish there, but I cannot see a reason to prefer them over anything. But as I showed you, I can't be bearish either. To me, that is a confirmation of this chop 2560, 2400. That is, to me, that is the most likely thing that is likely to happen over the course of the next couple of weeks. As simple as that. I've left this dollar thing here simply because we are at 96.50. We continue to be at 96.50. But now with my fundamental view about what could happen, if this is seen, the 93.63 area, you want to buy as long, you want to get as long as volatility and gamma as you possibly can, because the move from there is going to be huge in either direction. As simple as that. I still think high beta is going to get killed at some stage next year. At the moment, I will actually take this off because it's done its purpose, right? It's got you, it basically has got you out of what should have been warning signs, and it's done its purpose. You got out of high beta months ago, and now you can trade it. To me now it's in a trading range. I am no longer that worried about high beta stocks because I'm looking for a chop. It's as simple as that. I'm sorry that I'm not as bearish as many people would like me to be. I just can't see it. To me, it's far more likely to stay in a tighter and tighter range, which will coil up and then explode at some stage, but for the time being, smaller ranges and lower volatility. Thank you very much indeed, and tweet you on Monday.